time, I think since last time I've seen you, we had the sort of a big sigh of relief on that jobs number, that it wasn't derailed. And we also had the inflation. Suddenly we're worried, but we also had Powell like rubbing salve on the markets. Where any concern about whether he was losing his impulse to cut. It's amazing what we've seen. Do you think he should be reevaluating that? A lot of people do.
No, I understand that we've had some good economic data, but I think Powell made it very clear it's not just about growth. It's also about inflation. And we heard in that comment from Powell yesterday the concern that the Fed has in falling behind on the inflation front. I mean, they look at the inflation numbers now, which they cannot keep at 2% in what is really the best of times for inflation. You've got an extremely tight labor market. You're not getting a sharp acceleration in wage growth. And as I said, you can't keep inflation at 2%. My goodness, what happens if the economy eventually slows and or inflation expectations, which are actually uncomfortably low, even in these so-called best of times for inflation? I think the Fed is quite worried about trying to be ahead. So it's more than not get behind the inflation curve. And as I said, it's more than just about growth here. It is about inflation. And I would just, what Steve mentioned, I think is important. You know, I think Powell was asked point blank on the first day of testimony, is there anything between now and the end of the month that might change your mind? And he was very clear. They're not looking at any one number. They're looking more broadly. And so I don't think actually, even with a 300,000 job print or a 3% GDP, I just don't think this Fed is going to be deterred, you know, between.
It's happening. July's definitely happening. And Joe, to your question, I think we would perhaps, I mean, we acknowledge it's happening. We would perhaps say, what good is it actually going to do, frankly? The issues pushing down both inflation as well as investment here domestically and globally are not going to be fixed with a rate cut or two, or maybe even 9. So we question, actually, what is it useful for, and perhaps could it do a little bit more harm than good?
Yeah, here we are.
But it's happening.
And we're sucking you into the Fed discussion. And like Kramer, you're sort of saying, can we just talk about companies and earnings, please? So we are coming into an earnings season.
Yes. And
the question is whether it's going to be something that gives support to the market or something that scares the market. The Fastenal number was a little bit scary. Kramer seems to think it's going to be a pretty good earnings season. Where are you?
So, yes, we've been very central bank heavy the past few weeks, especially this week. And I do think starting next week, the attention shifts. And
Will
we
it be
shift
good?
back.
A good season or a bad?
I don't necessarily. I think the second quarter expectations have fallen a lot. We will beat. I do think the attention's for the second half. There had been this expectation and guidance before and in consensus that there would be a bounce back in activity and earnings in the second half of the year. And that does not seem to be happening. So we do think we'll get some slightly, shall we say, negative guidance for the second half of the year.
Isn't it hard to go into earnings season when you're pretty much at record highs? I mean, you really, I mean, if you're a company that is looked upon favorably in the markets right now, you're probably sitting at a 52-week or an all-time high right now. So you're going into earnings season with stock strength. Either that or you're a company that's seen as somebody who might suffer because of the China trade war, and you're going in weak with the expectations that are weak. So it seems almost like a lose-lose situation when it comes to stock reaction.
And we do think, you know, the Fed and dovish central banks are happening. They'll put a floor to risk appetite, to the markets, but we're hitting upon a ceiling right now. And it does come back to this idea about earnings and economic growth that, frankly, are very depressed, and we don't see that changing, perhaps even getting a little bit weaker in the second half.
Yeah, but I was just many times stocks that hit new highs then hit more new highs and then more.
Well, I mean, you could have
like lows. I go, I can't sell here. When I was a broker, I can't sell it here. It's at a new low. Next thing you know, it's hit like 10 more new lows.
Sure, no, of course. Or you could have an earnings result like a Pepsi,
right?
Where Pepsi came in, they were at highs, they reported a good quarter, and the stock finished lower on the day. I mean, I'm just
right. But could you see where it actually there were numbers come out that actually justify where it is now and actually have people say, "Wow, I'm no longer worried about a bubble. I'm no longer worried about an air pocket."
Of course, that can happen.
I wonder which one it's going to be.
We're sort of worried, I guess, if anything, about this disconnect between where equity equity prices are, and so many other indicators like.
But that's your fault, because
well,
it's the Fed.
I don't disagree that the problem the Fed has is in trying to, for example, get inflation up. What we're seeing is that asset prices are far more responsive to Fed accommodation than consumer prices. And so the Fed is taking actions to support the economy and, importantly, to boost inflation and inflation expectations. And the result they're getting is higher and higher asset prices, and this disconnect between sort of what growth economic indicators are signaling and the level of asset prices. So I don't disagree with some of the concerns that are being voiced here.
But sometimes the wealth effect being engendered by the low interest rates saves us from Armageddon.
Well, it's always, it's a little counterfactual. We talk about the fact, too, what I really agree with you, in some ways, what good is 25 or 50 basis points of rate cuts? On the other hand, if the markets, if we didn't see that action from the Fed, because the markets and inflation expectations have both responded favorably since the Fed signaled rate cuts, if we didn't get them, you might be talking about a very different scenario. And then you say, oh, well, now I get what rate cuts will do.
I think you were on Fast Money with me too, weren't you, at some point? Or
Yeah,
what was your year-end target on the S&P now?
So for us, we think we're pretty much there. That there is definitely much more limited
below
upside
where we are
here.
now?
So for us, within asset management, we don't do very specific targets there. We tend to look a little bit longer.
2,900 on the SP seemed fully valued at the time.
Perhaps. I think. I think on
3,200 would blow you away if that were to happen.
I think so. I mean, we wouldn't completely rule it out that it could happen, right? But when we look out over the rest of the cycle, shall we say, so less about the next 6 months, the next 12, 18, 24 months, we do think the upside is a little bit more limited from here, right? So the approach we're taking is focusing less on capital appreciation, so just the market going higher, stock prices going that much higher, focusing more on income, more and more on income.
16% so far this year. Anyone in the right mind would take their money and go home, which makes me think that's the easiest thing to do, right? Take your money and go home. I don't know. We'll see. I'm surprised it's up today. What I heard was after the China truce happened 2 weeks ago, I heard, okay, no more good news is coming, really. And, you got, and the market just seems to be melting up.
We're riding that central bank wave.
I guess.
Soon attention's going to shift, I think, back to what's really happening beneath the surface.
Okay.